How's it going out there? It's Thursday, June 2nd, and you're listening to the Wall Street Unplugged podcast, normally hosted by the one and only Frank Curzio. However, he is out traveling today and tomorrow as a programming note. You are stuck with me today. Hi, Daniel Creech, senior analyst here at Curzio Research, where I get to talk about things that interest me and convince you, dear listeners, as to what you should give a flying Florida about in today's markets. Always love filling in for Frank here. Glad to be back. Was back on yesterday's podcast. And again, since I said he's traveling today and tomorrow, for all you paying subscribers, our most favorite types, I will be doing Frankly Speaking. So send any of your questions or feedback to me, Daniel at CurzioResearch.com. That's Daniel at CurzioResearch.com. When I'm behind the mic, I love to take the helm here. I'll give you the world according to Creech and the markets right now, what to expect. And let's start off with how to prepare yourself. Brace yourself for the coming hurricane. And we have to figure out if it's a small hurricane with light winds or a damaging hurricane. Yes, I'm having some fun with Jamie Dimon, JPMorgan CEO, and one of the most respected and best bankers in America. And I actually like Jamie Dimon from what little I don't know him. But I like how he can change his mind. He can admit he's kind of a, he's one of those elitist humbles at times to make us small guys feel good. But Jamie Dimon was all over CNBC yesterday he was talking to investors, and he was talking about how, hey, there's a storm cloud coming. We have decent times right now. It's sunny. It may be a little cloudy, but boy, headed down the road, we got to brace yourself. And he says, JPMorgan is bracing ourselves, and we're going to be very conservative with our balance sheet. Now, why would he be foreshadowing, warning, pointing out, some would say the obvious, that you should take cover or brace yourself? Well, the CEO said the other large factor worrying him is the Ukraine war and its impact on commodities, including food and fuel. I'm going to dive deep into oil here in a moment, but Frank talked about the food prices and how they're going to be sustained and continue to go higher on Tuesday's podcast. Be sure and check that out. Dimon says oil could hit $150 to $175 a barrel. That's up from about $115 right now. I'm going to give you the answer first and explain why you should go ahead and continue listening here, because if you feel like you've missed the massive run in oil or energy stocks, I'm going to tell you you haven't. I'm going to share some stats as this podcast unfolds as to try to convince you and make sure you at least have exposure. My goal here is to break down, explain, hey, here's what is catching my eye. Here's why I think you should give a flying Florida, remember it's a family program, about this, and make sure you position yourself in your portfolio so that you benefit and don't get hindered or hurt by the volatility and a lot of the market pullback in general, because energy has been working. It will see its ups and downs. Don't get me wrong. I'm not saying it's all going to be straight up from here, from current prices across the board. But overall, I do think higher energy prices and higher stock prices related to energy are in the near and distant future for a couple reasons. So let's pay attention as to what's going on. We know about the awful war between Russia invading Ukraine. We've talked about that. I may address that some more on Frankly Speaking. But I want to point out to something here, because these kind of things take time to unfold, whether good or bad. When you have a spill in the river, obviously that's a bad, but it's going to take time to work its way downriver and to other areas. And that's what we want to try to think about investors is, where's the puck going? Okay, how are we positioned for today, and why, and what's changed? So our new environment here, and the reason Jamie Dimon is warning everybody is because now you have the Federal Reserve switching gears. Instead of going from a easy money policy, low interest rate environment where growth and borrowing money to grow and not make revenue was rewarded, that's the mentality. That was the base layer the Fed put, as you would call it, to support higher asset prices across the board. And when interest rates are zero, you can justify a lot crazier higher asset prices. Now that's changing in two ways. One, quantitative tightening, where the Fed is going to stop purchasing as many bonds, stop buying bonds, and start selling them or letting them roll off their balance sheet, which means they're taking a massive buyer and a massive provider of liquidity out of the market, which the market in theory is going to have to figure out where those rates are. No pun or no shock here, but rates are going to be higher. That's why you're already seeing them go up. In second, and what they're doing first with that is the Fed is actually raising rates for the first time in several years, and we've talked about that a lot. So Jamie Dimon is pointing out, hey, the forward picture, the road up ahead is much, much different than the rearview mirror. And I appreciate that, and I totally agree with him. The same mentality of buy the dips in the tech sector that we've had for several years, call it the last decade, where growth has vastly outperformed, will continue. It's just going to shift over to different sectors, like the energy sector. And what I mean by when you see these headlines about the European Union in the United States is sanctioning Russia, causing more economic harm over there. They're disrupting. They're trying to cut off their economies from Russian oil. What does that do? Well, Russia is one of the largest, 3 producers or so, top 5 at least, in the world. You take away their main product, you take away their funding, you hurt their economy, then they can't fund their war. The problem with that is they're going to continue to discount their oil and get money from China and India. They've already admitted and are buying lots of oil. I understand what the governments are doing in a perspective, but most of it is just show, because that's what politics are, to gain votes. If we consider what they're doing, what has happened here in the last couple of days? You can go through the Wall Street Journal or major financial news outlets. You have Biden writing an op-ed, which I'm going to go over in the Wall Street Journal. My plan for fighting inflation. You have Jerome Powell getting called to the White House for a meeting with Biden. Of course, they're totally independent of one another. The Fed and the White House don't want to talk. If you believe that, I have some wonderful oceanfront property in Arizona I could sell you, and many friends of mine have them too, which I'll be glad to introduce for a small finder's fee. You have Janet Yellen, Treasury Secretary, former Fed chair, admitting that she got inflation wrong, but now you should listen to everybody because it's all going to be okay. And how are they planning on to fight inflation? Well, from President Biden's op-ed from Tuesday, May 31st here, he points out quickly, I won't meddle with the Fed, but I will tackle high prices while guiding the economy's transition to stable and steady growth. That sounds great as long as you don't need any merit behind it. The upsetting thing here is that the obvious answer for lower prices, to lower gas prices, oil prices, is to increase production. And we could easily do that if we had policies in place, but we don't. I'm not going to rant about politics here, but we simply don't have an encouraging or a tailwind from our government to incentivize and encourage oil producers to produce more, to make us more energy independent. We have in previous administrations. We've seen how that works. Results are very easy to see. That's not the case right now. The issue and why you should be bracing yourself for higher oil prices and higher sustained prices is because politicians aren't attacking the issue of supply and demand. They're just playing the blame game. And you can do you can do quick searches on the internet here for, look at Senator Elizabeth Warner talking about taxing oil profits. And it wasn't too long ago where they dragged some oil executives in front of Capitol Hill to explain, why aren't you lowering gas prices? How does this whole thing work? They're not incentivized to drill and increase production. They're incentivized, and even BlackRock, like I've talked about in the past, one of the largest asset managers who has decided to throw its weight around what they deem politically correct and better for everybody, put ExxonMobil board members in place specifically to be more of a green and get out of the oil business, essentially, from a macro perspective, to do less drilling, to be more environmental friendly at all cost. Knowing, do not kid yourself, that would vastly drive up the price of oil, and Exxon would benefit from it. I know that because allow me to pat myself on the back slightly. I have had losers as well, but I recommended ExxonMobil about a year ago because of that, because of those environmentally friendly, and I'm using air quotes here for those of you following along, environmentally friendly board members. And what has the price of oil done since? Gone up. Now, there's been other factors, of course, but Exxon has definitely benefited that. It dropped a quick 10 to 15% after I recommended it in June of last year. Now it's up roughly 60%, not even including dividends, knocking on probably $100 a share. I haven't looked at it most recently. But when the government policies are attacking whether oil companies for the price of oil and blaming Putin, they're showing you their hand. They're showing you that, hey, this is the blame game. Here's the cards we're going to blame, whether it be recession or lack of GDP or higher interest rates. It's all because of higher energy prices, and the Fed has to get this under control. That's just not going to fight the problem, which is why you as the individual ought to understand oil prices are not going down anytime soon. In the op-ed, President Biden highlights that he was released one of the largest strategic releases from global oil reserves in history. That's including the U.S., and he got partners around the world to do that. He announced that he was going to release about 1 million barrels a day, and that added up each day, 1 million barrels a day across the board each day at the end of March. Okay, so oil hit its recent high, about $123 a barrel. It's only $115 now, 6-7%. Gas prices continue to go higher. But again, they've shown you the cards. It's not about fixing the prices. It's about who they're going to blame and how they can do that politically. That macro level is higher energy prices. Number two, so to get back on track here when things take time, that's President Biden. That's what's here in the U.S. And oil companies are now incentivized to store up their balance sheets and pay massive dividends and buy back shares to reward shareholders through this new sustained higher energy prices. So you should take note, look at your Exxons, your Chevrons, your Devon Energies, Viper Energy, VNOM is the symbol. We've talked about that in the past. Turning across the pond here, the European Union takes a big chance on oil ban. This is also from the Wall Street Journal. Wednesday, June 1st. One of the interesting things they did was not only they're banning oil shipments, but they're going to ban the insurance or insuring of Russian oil cargo. That's a topic for a different discussion, but that interests me, A, because I love insurance and the inner workings behind it, and B, because a lot of the insurance on those oil cargoes, doesn't necessarily have to go to the European Union for those Lloyd's of London and different types of insurers within the European Union to write those contracts. Let me see here. So I'm switching back and forth. Energy headwinds rattle Europe. This is from Tuesday, May 31st. And I just want to point out some highlights because everybody wants to talk about getting off oil for the necessity and the human rights thing and to protest the war, which I agree with. That's fine. What they're not telling you is the reality that it's not going to help the individual who they claim it will. In Germany, Europe's biggest buyer of Russian gas, wildlife protection groups routinely challenge wind farms, stretching their approval time for more than 5 years. In Italy, Europe's second biggest Russian gas producer, authorities reject 90% of all wind energy projects. Okay, this is before the war broke out and before it got politically correct to get off and just blame Russia for everything. Skipping ahead, listen to this. Almost 600 renewable energy products are currently being reviewed by the ministry, which didn't respond for comment. Now, this is the Ministry of Culture overseas I'm talking here. And I'm cherry picking out of this article. My big point here is the takeaway is that when you see the headline saying we're getting off Russian oil and we're going to replace it with cleaner or greener energy outside of natural gas and nuclear, which isn't as easy just to turn on and switch over everything to supply and keep their standards of living at normal. That's why you're seeing price hikes all over across commodities, and think of how bad that's hurting the individual. But all that be damned, everybody is playing the blame game from governments over here in the U.S. to governments overseas. And this is an easy foreshadowing of seeing, hey, not only can they blame higher prices now, but they can blame the recession, and everything else is going to get lumped into this. So that's what you need to be aware of on the form of energy front. A couple more minutes here just on energy and why. I want to share some fun stats, and take all this with a grain of salt here. This is from, let's see, where am I at here? I'll see if I can share some links, but I had a Siblis research, and if you just search for different sector weightings in the S&P 500, Chris McIntosh, who we need to get back on the podcast, has been wonderful about looking at and I think Cuppy as well, two great guests we've had on Wall Street Unplugged. We're talking about, or have pointed out on Twitter and different broad areas, how the investment dollars or the weighting of the S&P 500 is still very low to energy in terms of, to other asset classes. So for instance, on this, I'm looking in December of 2020, energy made up about 2.28% of the U.S. stock market large cap sector weightings. That increased to a mere 2.67, so from 2.28 to 2.67 at the end of 2021. Let's say that went up from December of last year to 6 months later, here we are, another couple percent. That still means that energy represents only 5% of large caps on the S&P 500 sector weighting. Compare this to information technology being almost 30%, communications 10%, consumer discretionary over 12%, financials 10%, healthcare 13%. Energy is still a drop in the bucket, and what that means is that there is still a lot more money that can come into this space, meaning oil prices will stay substantially higher. The new normal is higher prices. If those spike to, say, 150 to 175, like Jamie Dimon predicts or warns about, that money will come flooding in even more. A lot of volatility will be here. But because of those companies, because of drillers like Devon and the other companies that have these split or adjustable dividend plans now, where they're going to give you a fixed dividend, and then based on cash flows in the previous quarter and earnings, they can increase that. That is going to attract a massive amount of capital as you continue to see high growth and stocks get sold off. And that's what, hopefully, I've drilled into your head on this podcast, that if you don't have exposure to energy and commodities, I'm going to make a quick comment about commodities right now, but you need to, and you can scale in, you can buy over time, buy a third of a position or a half a position or whatever you normally would, wait a little bit, and then look to add to that, whether the price is up or down, as long as the thesis doesn't change. And as I've pointed out, you would really need government policies to change in order to drive the price of oil and gas lower, and that's just something that's not going to happen right now, in my opinion. We'll look forward to, unpacking that and things as the weeks and months go on. But understand, you need to be prepared for this stringing out of volatility and lower asset prices and growth for the next several months, even into this year, because the Fed's going to meet here a couple more times towards the end of the year. The big thinking is they're going to pause the rate hikes in September, ironically, right before the midterm elections. Don't need to go there either. But that doesn't, you've already had Fed voters and non-voters, Fed board members come out and talk about how that's not a reversion back to the old days of easy money policies or a pause. They say, and they're still supposedly serious about fighting inflation, which means higher rates, which means you're going to see this money allocate towards energy and commodities. On commodities, real quick, do not be fearful of having some exposure to gold. I know Frank and I disagree with that on the real interest rates and when. He's been right so far. Gold has been flat. Copper and metals and mining like Tech Resources is trading near 52-week highs. Pay attention to that one. Do your own research on this. These are just some ones I'm throwing out there for you because I want you to have exposure to these with tailwinds. Offshore oil companies as well. But metals and mining tech, look at Freeport-McMoRan, and even your boring gold producers like Newmont Mining they just have a lot of tailwinds at their back with either sustained gold prices. If you just don't need gold prices to fall out of bed. And with all the nervousness and all the money printing and all the chaos and inflation going on, don't feel like you've missed the boat on oil, and don't give up on just regular commodities. And some of those, like the metals and mining, like Tech, Freeport-McMoRan, have had nice pullbacks from recent highs, and I would definitely look to be a buyer of those. Again, scale in. Know this is a long-term game. This isn't a sprint. Don't get caught up on the day-to-day headlines. Stick here to us here at Curzio Research. Definitely tune into Wall Street Unplugged. Like, share, subscribe. I can't thank you all enough in advance for your feedback and just the opportunity to do this. I absolutely love it. When I was on vacation, this was by far the thing I miss most, other than my family, is sitting behind the mic and doing the podcast. So Questions, comments, feedback, Daniel@CurzioResearch.com. I'll see all the paying subscribers tomorrow for Frankly Speaking, and Frank will be back to everybody on Tuesday. Have a great weekend.